Data shows that we could see a crash in the coming weeks, but even if we don't see it in the coming weeks, you need to realize that this is a market that's going to be incredibly weak for a long time. Much, much longer than people anticipate, because we don't have the Fed to lean on. I mentioned it earlier. You might be thinking about 2008 or 2020 type crash in the markets. What happened? We rebounded sharply, right? We got to bounce really quickly in 2020 because we went nuts of spending. And 2008 was not that long. Even towards the end of 2008, stocks ran up before coming back down, right? So it wasn't the whole 2008 that was terrible. You get that rebound pretty quick. But that happened because the Fed printed an insane amount of money to help stabilize the markets. They gave the market a floor. It said, hey, we're here. In the credit crisis, we'll buy all the shit. We got it. Banks, give us all the shit. We'll buy it. We'll take the losses. I told you the worst thing. Not that I hate saying told you so, because I've been wrong on other things and lots of things, but the worst thing that happened during the credit crisis, the worst thing, it's not what the Fed did to have to do and the government did what it have to do and stabilize the system. Okay, it would have been 30% unemployment. The whole financial system collapsed. People couldn't get their monies out of banks. They needed to do something crazy. The worst part of it is that they made a fortune and they made it quickly because everything rebounded so fast. So they didn't see the consequences of their actions. That was the biggest negative. They made an absolute fortune, taking over Fannie and Freddie, buying all the mortgages, buying all the assets, and then all those assets surged in the years ahead. And Fannie and Freddie is still in conservatorship. They made money so fast they didn't have a plan to say, okay, well, how do we get out of this? Well, let's not get out of it. Let's just continue to generate billions and billions of dollars for ourselves every single quarter. Nobody talks about that. But they made a fortune, bailing out AIG, bailing out all the banks and the warrants and all that shit. They made a fortune. The Fed's not there to print money this time. Not if they want to control inflation. Again, inflation is still exceptionally high at 8%. We've never seen 4% inflation in any year prior to 1991. And we're at 8. And you think you're going to see a meaningful pullback? We're not. Because the Fed only looks at two things: unemployment and the CPI. If you listen to past podcasts, you know that the way these two indicators are calculated, and I dug in and went back from 83 to 91, where you saw the CPI revised from the rental portion and the shelter portion, which counts for 30% of CPI. It was revised, I think, 27 times to make sure that that gauge actually stays low for a long period of time. I mean, you look at rentals only went 3%, even during the periods of 2006, 7 or 5, 6, 7, when home prices were going up 20%. On average, annually then, which led to the bubble. Rentals didn't go up that much. But now rentals are up, 18% last year, high double digits this year. They're not going to go lower because we have a supply problem. Now we're looking at affordability index. And again, I'll cover this in my presentation, which is at 35, 37 years highs where it's less affordable today to purchase a house than any other time in 35 years, which means if there's a supply problem, people have to live. So what are they going to do? They're going to rent, which is going to keep prices higher. And that's scary. Because what does this mean? It means CPI, unemployment, they're not going to come down anytime soon. I'm talking at least over the next 3 months, probably longer, which means the Fed is going to continue raising rates. And they're going to raise them past 4% and keep them there for all 2023. And that is an insane picture. When I close my eyes and think about that in my head, that's insane. Considering right now at 3.25, almost every market one by one is freezing. I mean, housing is done. Housing was done when mortgage rates went past 5% to 7%. The semiconductor companies, I mentioned them earlier. I mean, holy cow. Look at all the warnings, the massive warnings. AMD, the latest PC sales. They said they're crashing. They didn't say supply chain concerns this time. Now they're talking about demand. This is AMD, one of the biggest growth companies in semis for a long time. Retail. Did you see Nike's inventory levels when they reported last week? They were up 23% the previous quarter. And when you have a big retail like that, even Walmart did a good job selling off their inventory. You got to sell at cheaper prices. It's seasonal. So people are expecting, they got rid of a lot of inventory. Yeah, margins are going to get hit. Their inventory levels went up another 44%, meaning, holy shit, we're lowering prices and we still can't sell our goods and clothing. 44%. Look at autos. Seeing downgrades of Ford and Demand's not there. You're building all this stuff. You had supply chain concerns, so all this demand. So you did everything you can, spending a fortune, building more factories, and in an instant, boom, demand's gone. That's what happens when you raise rates this fast, by this amount. Look at industrials. Every industrial company is lowering estimates, laying off employees, and now the banks. And banks are well capitalized. This is a different type of crash. It's not like you have to worry about it. They're well capitalized, but seeing massive slowdowns in the global economy, which all these big banks have tons of exposure to. Of which Jamie Dimon, CEO, JP Morgan, said on TV yesterday, if you're a company and need cash, he actually said this. If you're a company and need cash, I suggest you raise money right away. That's code for the shit's going to get a lot worse going forward. That's what he's saying. So I'm going to break everything down in this presentation. It's absolutely free. You see all my data, all the analysis. I'm talking about a lot of companies, Fed policy, what they're going to do going forward. I'm going to show you how I could be wrong, which I always do in my analysis, or what we need to see for stocks to bottom, which I'm hoping for. But as you can see, those catalysts are not going to happen, or likely not going to happen. And most importantly, I'm going to show you how to make a killing using a very easy low-risk strategy that anyone could use. It's simple. Use your PC, your phones, or your online brokerage account. This strategy already generated over 30% returns this year, and we have that documented. That figure doesn't tell the whole story, because many of these positions were closed out in less than a few months. So if you're using an annualized return, the average position has gained 130% this year. While the S&P 500 is down 25% and the NASDAQ is down 32% through September. And this isn't just like cherry picking. These are the returns. This is based on 12 closing trades this year, with 6 are triple-digit winners. One closed out for 217%, the other for 271% returns. And again, these gains came in just a few months. This is how the best investors in the world play these markets, which they love to see. They love to see markets like this. They don't happen often. We see massive pullback and assets are insanely cheap, but you see the most experienced people in the markets. They tighten up because they want to have as much money as possible when we bottom, which we will bottom. It's just not going to happen as quick as everybody believes. It's going to take a while, a long while this time. So it's not just, oh, let me go into cash, or let me buy some of the safe haven companies that are paying, nice dividends. Well, let me tell you something. The average dividend on the S&P 500 is 1.8%. The 2-year is 4.2, 4.3%. Why even take the risk for? Just buy the 2-year. Why take the risk for with everything going on, with all this uncertainty? With central banks for developed nations confused as hell and have no idea what to do and can't even tell you what to do. With industry by industry seeing demand destruction, and we're not even close to being done yet. I mean, even if the Fed stops, which is called a pivot, that's not really a pivot. A pivot is doing the opposite, which lower rates. They're not going to lower rates for a very, very long time, especially with inflation at 8%. But even if they, I'll use their definition, pivot and stop, it's not going to get any better. People aren't going to suddenly say, oh, wow, the Fed stopped. I'm going to go out and buy a home and take out a mortgage at 6%, 5.5%. And we still haven't seen the damage from what the Fed has done so far. And that's the catalyst. That's a bull catalyst that's being talked about. Oh, the Fed's going to just wait and see. I thought that was the case 3 months ago, and they were like, they were going to be done. I had no idea they're going to continue on the pace. And they're going to continue because they look at 2 indicators, lagging indicators that are flawed, that are calculated wrong, which I'll explain in my presentation. But you need to protect yourself. But the best investors welcome this type of market. So we're not talking about going to cash or buying the bit. We're talking about making a killing while stocks get killed. And it's a nice situation to be in because you are usually the person that gets effed all the time with SPACs, right? They only work, the retail environment needs to buy these things and needs to be sold these things at 100 times sales and 50 times sales and buy them at 10, 12, 15, while everyone else who's selling to you bought them at $1 and below. You don't know that. Retail investor, you guys always getting screwed, You know what? Let's make money this time as everybody else gets screwed. As companies overshot, overspent. We got a Fed who's a bunch of idiots that should be fired right away. They're not qualified to be in this market. We saw that. everything they've learned for 40 years plus told them last year when inflation was at 5% is going to be transitory. And just a year later, now, not only is it transitory, we're going to raise rates by the fastest amount ever and continue, and it's going to last forever. I mean, come on. You are not qualified to run the most powerful organization in the world, which can cause a global recession and a depression, which they're on their way of doing. But the people who make the most money and do well, they welcome these markets and they make a killing on the way down. That's how you create generational wealth. Money can be passed down to your kids or your kids' kids. You may think that happens when bull markets. Everybody makes money in bull markets. Bull markets go high. Everyone's a genius. It's the people who position themselves now. When the shit hits the fan, like we're supposed to see every 3, 4 years, 5 years of recession, but the Fed didn't allow it. All that money printing, all that spending for 12, 13, 14 years. Now's the time you got to take your medicine, and the Fed's taking their medicine. And they're not going to be there. They're not going to be there for you. It's important for you to understand that, guys. And we saw a market with the NASDAQ crash. And if you go back to the prior 3 crashes and going back .com, and we went to that recession, right, from 2000, 2001, 2002, all through 2001, the Fed, I want to say, lowered rates. I think it was 6% to 1.75%, all 50 basis and 25 basis, nothing even close to 75. They went like, no way. Right, so they started cutting rates tremendously through 2001. At least 10 times. It's like 8 to 10 times. And then you had 2022, they lowered them, and then 2023, you lowered them again. And through that period of 3 years, the markets kept coming down and coming down and coming down despite lowering. That's how long it takes to filter through the system. Now, why didn't we see the quick pop like we saw in 2008, 2020? It's because the Fed was printing money recklessly. Recklessly. The Fed's not printing money this time. They're not there for you. So we're likely going to see, if you want a comparable market, it's probably going to be the .com, where it's going to be long drawn out. It's going to happen right away. And maybe there's effects that won't happen right away. We're going to election year. We know what politicians could do and let out prisoners before and, really load a strategic oil reserve, which every single president has done ahead of an election. Not to this extent. Again, that's what they care about, power. But this is your opportunity. Forget about the Fed. I don't care what side you're on. Politicians don't give a shit about you. You should know that no matter what side you're on. They only care about power. You know that. This is your opportunity to make a killing while these guys get smoked for the first time. I'm going to teach you how to do it.